Hi, I'm Luca Mannucci, managing partner of Sella Venture Partners. At Sella Venture Partners, we focus on providing access to a selection of VC funds both in Europe and in North America for European investors. In particular, we have two strategies. A primary strategy where we underwrite selected top tiers funds, especially in the US. And then we have a secondary strategy within the funds where we buy mature funds, typically around year 6 and 7, discount where we know the manager and we know the asset. Typically, we balance the allocation of the fund with 60 to 70% of primary allocations and 30 to 40% of secondary allocations. So the two allocations, they actually fuel each other. So we use the primary allocations to also source a lot of the secondary deals that we find. So typically what we do, we work with the manager where we allocate capital, and with those managers, we provide them a solution for liquidity for their early funds. So first of all, discounts in VC are consistently larger than in buyout, and this is for a variety of reasons. First of all, there is a scarcer level of buyers in VC market. Then the level of information that we typically are provided with is not very complete, so you have to complement it with data points that you have to find in the market. And also, thirdly, we have to work with seniority or structures for the shares that we buy that not necessarily are preferred shares. We sometimes have to buy common shares. So in that sense, we have to discount everything that comes after common shares. In general, we see deals with an important level of discounts, but I think it's important to stress that discounts is not the most relevant aspect here. So discounts is not the most relevant aspect here, at least for us. The focus really is on the quality of the asset that we buy. The quality has to be absolutely known, first of all, and very important. Discount is a nice to have, but it's not a must have. Well, in VC, we all know that there is a sort of a power law. So basically the top 5% of the companies, usually the return, they provide the majority of the returns for the funds. So you really need to focus on those companies that have the good metrics and have the good scaling, and which they can provide you actually to access that 5% of top market for VC. So that's where we usually really need to focus. And this doesn't necessarily come through top brand names. Sometimes you can access those companies also through emerging managers that have early access to those assets. It's usually a combination of the two. Deal flow comes in different ways. So clearly we use the few intermediaries that are in the market. There are some intermediaries. First of all, we focus, let's say, on the lower side of the market, which is a very untapped market. So our typical ticket that we underwrite is between 1 million and 5 million. So small tickets. As said, we work a lot with GPs that we know. We approach other GPs that are looking for liquidities for some of their earlier vintages. All this usually brings together a good source of deal flow. Like last year, we had an amazing amount of deal flow that we were able to look into, and this year too. Yeah, typically, US is a bit farther. So US, we do underwrite tickets on the secondary side, but only on GPs that we know, and where we can have really a good level of data point for the companies that we buy. Well, first of all, it's a market that hasn't been liquid for already 3 years. So there is a run for liquidity most of the LPs are looking for liquidities these days. And, secondary markets are usually pivotal for illiquid markets. So they're usually a pivotal function of illiquid markets because they're able to provide many different aspects to LPs. So you can use secondaries to do your risk management by rebalancing the portfolio in certain moments of the cycle. And clearly you can use secondaries, you can tap on the secondary market in order to get the liquidity that you might need in order to start investing again into newer manager and into newer funds. So we typically underwrite generalist funds, so that's the majority of our funds. We see a lot of opportunities in those segments. Within generalist, we see a lot of opportunities in those segments which are not too hyped. Like now, there is less hype on the SaaS market, so we see a lot of opportunities, especially for discounts in the SaaS market. We see a lot of opportunities in fintech after a season where fintech was absolutely very expensive. We see a lot of opportunity in the blockchain technologies. There is a bit of a revival in the blockchain technology, especially these days. So on the primary strategy, we typically underwrite managers which are generalists. We never go for vertical manager. It's part of our vision of the market, and the vision is that the most important funds will always be generalists. If we think about the past, in 2004 there was the IPO of Facebook. There were no funds that were social vertical on socials. I think the verticality of funds always comes after the good breakthrough in the market. So we look for generalist funds with few exceptions. One exception is clearly biotech, life science, where clearly you have to be specialist. And on the general tech side, I think there are fewer exceptions. Probably one is cybersecurity, just because typically technologies in cybersecurity are repeatable, and so using somebody that has a complete vision of the vertical can be helpful.